$111,470.24. This is the average value add of the Roth Conversion Timing Strategy that I'm about to show you in this video. In fact, I'm going to show you 5 different Roth Conversion Timing Strategies and show why the most commonly used strategy is actually the worst of the 5. So if you're someone who's making this common Roth Conversion Timing mistake, you're going to want to watch this video and see how much money you're actually leaving on the table. Let's get into it. And so let's say that you know you need to perform a Roth conversion in your forward-looking tax plan, which you obviously have because you've been watching our Safeguard Wealth Management YouTube channel and you know how valuable a forward-looking tax plan is for your retirement. Inside your forward-looking tax plan, it shows that you have some tax-infested accounts. And in fact, those tax-infested accounts down the road, because of things like required minimum distributions at age 72, will force you into higher brackets, different tax hurdles, and be very costly to your situation. And so you know you need to perform a Roth conversion. Well, what is the best way to actually perform this Roth conversion? This seems like a very small question, but as we're going to show in this video today, the timing of your Roth conversion will make the world of difference in how much you actually save on taxes. You have 5 different options when determining your Roth conversion strategy. We're going to talk about each of these 5 options using the example of a $100,000 Roth conversion for the year, just for simplicity. And then we're going to test each of these timing strategies over a swath of data. So make sure you watch until the end to see just how much of a difference each Roth conversion timing strategy will make for your situation. Most common approach is a year-end Roth conversion. So going into that year, let's say that you know that you want to convert $100,000. And so you wait until December. Easily 90% of the investors that our team meets with is using this type of strategy, waiting until the end of the year. Unfortunately, this is certifiably the worst of the 5 Roth conversion strategies. On the surface, it's reasonable why somebody would choose an end of the year conversion. By the end of the year, we fully have clarity on what our tax situation is going to look like. We won't have any surprise income at the last minute. And so if you wait until the end of the year, if you have surprise income, let's say capital gains from your taxable account or dividends from your taxable account, that might lower your conversion, you can just adjust your conversion accordingly. But here's the biggest problem with this strategy. We're waiting until the end of the year, and throughout that year, we expect our accounts to grow. And so let's say we have $1.5 million IRA. Over the year, we had reasonably good growth. Our accounts grew by 8%. And so our $1.5 million IRA grew $120,000. And so now at the end of the year, when we're performing that $100,000 conversion, we're not even making a dent in those tax-infested accounts. In fact, we find ourselves in something that we call the IRA catch-up trap, where when you're performing a conversion at the end of the year, you're performing that conversion after growth. And if your accounts are large enough, you may not be making a dent in that given growth from that account. And so you're constantly having to play catch up, doing larger and larger conversions or more frequent conversions on an ongoing basis in order to try to curb the growth of that given account. So let's look at the opposite timing strategy then. Rather than an end of year conversion, we look at a start of the year conversion. Now this strategy can be extremely beneficial because of 2 things. The first reason is we expect our investments to grow. After all, that's why we are investing. So when we're performing a conversion at the start of the year, we're having all of that growth happen within that converted amount. So within our Roth IRA, growing tax-free. Second, we have artificial constraints around when we can perform a conversion for that given year. The start of the year, January 1st, is the soonest that we can perform that given conversion. And so performing a conversion as soon as we can perform that conversion and have that be on that tax year can make sense once again because of the growth throughout the year. Now it is important to note the drawbacks for a start of the year conversion. Well, there are a couple. First off, if your investments lose throughout that year, well then you made a conversion when your accounts were at that high watermark and subsequently you could have converted at a discount. The other thing to mention too is part of the Tax Cuts and Jobs Act, they eliminated something called Roth recharacterization. Roth recharacterization basically meant that if you performed a conversion at the beginning of the year and you messed up with that given conversion, you could previously have called a mulligan and reversed that entire conversion. Well, the Tax Cuts and Jobs Act eliminated Roth recharacterization, so now when you perform a conversion, it is locked in for the rest of the year. And so a start of the year conversion can represent some tax risk. If you show too much income throughout the year and that would have subsequently lowered your conversion, you've essentially locked that conversion in at the start of the year and can't reverse that conversion. Now let's take a pause here and clear up a very critical misunderstanding. Previously, when I've talked about performing a start of the year conversion versus an end of the year conversion, we've received comments along the lines of, the value of this start of the year conversion is way overblown. You're only shifting your conversion schedule by 1 month. And so rather than doing a December conversion, you're only doing a January conversion. Well, let's go ahead and analyze this. In fact, this isn't the case at all. First off, let's look at what a end of the year conversion looks like for a couple different years. And then let's look at what a start of the year conversion looks like for a couple different years. So it's not that you're just shifting this schedule by 1 year or even 1 month. In fact, we're allowing for an additional year worth of growth for every subsequent conversion that we're doing. And we can see here that this snowballs into larger and larger compounding moving through time. The next strategy would be more of a diversified approach. It's commonly called a split strategy, otherwise known as a barbell strategy. And so instead of being binary and converting all at the beginning of the year or all at the end of the year, we're converting half at the beginning of the year and then half at the end of the year. With this strategy, you're protecting against surprise income, but you're also ensuring that at least part of that conversion is getting the growth benefit throughout the year. In reality, this doesn't need to be a 50-50 split. This could be a 75-25 split, an 80-20 split, anything like that. It should be custom to your situation. The fourth strategy would be the most diversified strategy of all. This would be equal distributions each and every month throughout the year. So rather than converting $100,000 or $50,000 all at once, you're converting $8,333 each and every month throughout the year. The main drawback with this strategy is that it's the costliest of the strategies in terms of time. You're having to perform a conversion each and every month. That takes extra time on your part or your advisor's part. And as you'll see when we get to the results section, the added benefit from this strategy does not make up for the time cost that we have to incur. Finally, the last strategy is something that we call a drawdown or discount-based strategy. So for instance, in a normal year where your investments rise throughout the year, we essentially revert back to our baseline being a barbell type strategy. So again, if we don't see any volatility within our portfolio, we don't see any drawdown within our portfolio, we're going to perform half of the conversion at the beginning of the year and half of the conversion at the end of the year. But let's say that we're in a situation where our portfolio is in a drawdown. Let's say in August, our portfolio is down 20%. And so in August, we perform the second half of that conversion because our portfolio is at a discount. And then when we transfer that given conversion inside of our Roth IRA and the market recovers, we're going to have converted a lot more inside of that Roth IRA at a lot lower tax cost because we're at a given drawdown. Think about it this way. Let's say that we want to perform a $100,000 conversion. Now our investment portfolio is at a 20% decline. Well, because of this, when we perform that given conversion, we're still performing that $100,000 conversion. But after the recovery happens inside of that Roth IRA, it will be as if we performed a $125,000 conversion because the market has recovered, but that recovery has happened inside of our Roth IRA. The important thing here is having a rules-based strategy that determines when a drawdown is large enough to warrant a Roth conversion. In terms of a rules-based strategy, there is varying value in terms of what that drawdown trigger should be. Now, if you're not sure what that should look like for your situation, in the description below, we have a link to our Safeguard Wealth Management team. So now that we've covered the 5 different Roth conversion strategies, which is the best? Well, we're going to run this underneath some historical data, but let's first cover what this study is going to entail. We're going to use a Roth conversion strategy of $100,000 for 8 years, essentially looking at a conversion from age 62 until age 70 as if you were delaying Social Security. We are going to use historical data starting in 1972. We're going to look at a all stock portfolio, a classic 60-40 portfolio, and then an all bond portfolio. And we're going to use a rolling window schedule. What I mean by that is we're going to start in 1972 and go 8 years till 1979. We're then going to shift that window 1 year. So go 1973 then to 1980. Results that we're going to show are going to be the average of the ending value of all of those rolling windows. So there may be a certain period where one given Roth conversion timing strategy ends up winning out because of some weird pattern of sequence of returns. Well, we're trying to average this all together to gain a statistical measure. In general, we don't care about just one specific trial. We care about the totality of all the trials that we run, so we statistically know on average which is the best. Finally, we are going to be subtracting out the actual amount that we converted so that we're just looking at the growth on the conversions. This makes sense if you think about it. If we weren't experiencing any growth within our Roth IRA, all of these timing strategies would look the same. In our Roth IRA, we would just have the amount that we converted. So we want to know the benefit from each of these conversion strategies underneath a growth context. So first, we're going to look at the results of this Roth conversion study, looking at U.S. stocks, again from 1972 till 2022, looking at 8 years worth of conversions. And we see on the screen right now the end of the year conversion on the far left. Again, this is the most common Roth conversion strategy that most retirees use. And as we see here, there is a drastic difference between this strategy and all of the other strategies. Notice that this strategy, in terms of overall growth through this period of time, only had $455,560.01 worth of growth. On the far right, we notice that the best conversion strategy here was the drawdown-based strategy. This makes sense because we know that stocks can be fairly volatile, and so the drawdowns are larger in terms of investing in stocks. thus presenting a larger opportunity for us to perform a conversion at a discount. Results from the drawdown-based strategy in terms of growth were $567,030.25. This is a $111,470.25 difference. We'll notice there's three strategies in the middle. The start of the year, split strategy, and equal conversions were all right around the same value in terms of the growth that you would have received from that Roth. So the more volatile your investment portfolio is, or the more volatile of the investment that you're performing the conversion out of, the better off you are using more of a drawdown-based strategy. But again, we would recommend using competent help in utilizing this strategy for your situation. And so there's one thing that I want to note here. From the best strategy to the worst strategy, there is a 20% difference in the overall growth that you would have received from your Roth conversion. 20%. That is an incredible amount in terms of getting more out of that given conversion. Next, let's look at these 5 conversion strategies underneath a 60-40 portfolio. Once again, you see very similar things play out. Again, in a 60-40 portfolio, you have bonds, which should be a little bit more steady of a return, and then you have stocks, which again are a little bit more volatile. Because of the volatility in stocks, we still see that the best strategy is this drawdown-based strategy. And then once again, we see that the middle 3 strategies are fairly similar in terms of the value add to your situation. Now, finally, let's look at this study and just invest in bonds. So looking at the 10-year treasury. Now we notice a little bit of shakeup between each of these 5 strategies. The only thing that's consistent here is that the end of the year strategy, once again, the most commonly used strategy, is the worst of the 5 strategies. But now we notice a new winner, the start of the year strategy. Now this is generally because in a drawdown-based strategy, investing in something like bonds where we're expecting a more steady return, we're not gaining as much value from using that drawdown trigger. In fact, in most years, we're reverting back to just using that split strategy because we're not seeing a drawdown trigger. Then not surprisingly, a start of the year conversion makes the most sense when we don't have that same volatility within our portfolio. Did you notice a consistency as we walked through those results? The worst Roth conversion strategy is the most common Roth conversion strategy. Using an end of the year conversion schedule consistently leaves tens, if not hundreds of thousands of dollars out of your Roth account and in your tax-infested accounts, translating to higher taxes down the road. And now what did we lose by implementing a better conversion strategy? Taxes were consistent. We didn't change the performance. We just implemented a better plan. That's an interesting idea. In all seriousness, let me offer some context around this analysis. The pure dollar amount of each strategy is not necessarily the most important consideration. For instance, in certain results, the start of the year conversion wins out, but it also carries the highest risk in terms of having surprise income that might push you up into certain tax hurdles like a Medicare premium increase. And if that happens because Roth recharacterization was eliminated, you're kind of a split strategy or drawdown-based strategy will provide the majority of the benefit that the end of the year conversion strategy misses out on, but will still give you room to plan for some unexpected income. The important takeaway from this training is how much hidden value is in something as simple as your Roth conversion timing strategy. And if something as small as this makes that large of an impact, what other hidden value is inside your retirement plan? Well, there's only one way to find out. Hit the subscribe button down below and then click on this video right here that shows a very powerful withdrawal strategy and shows how you can incorporate this Roth conversion timing inside of that withdrawal strategy to improve your retirement. And if you're looking for a financial team that focuses on the little things inside of your plan, there's a link in the description below for you to reach out to our team.